Looks like it's coming down to the wire here. 2 out of 4 stock market indexes are higher. Of course, the other is red, but not any deep selling now after a good bounce the past hour, and the Russell's up a chunky 80 pips. Randy Frederick and Kevin Gordon join me here for our big picture discussion. Kevin's a senior investment strategist, and Randy's a managing director trading in derivatives. Okay, so we getting cold feet ahead of inflation this week, Randy, or do we have enough data already to start panicking about bonds?
Well, I don't know if it's cold feet or not. I mean, there's a lot of things going on. Obviously, we got the government shutdown issue. We still got a strong dollar, although it did, frankly, pull back a little bit today, thankfully. Interest rates are moderating a bit. The PCE is definitely the most important report. We get that one on Friday. It's likely going to show a little bit of an uptick. We've seen that for the last 2 months in both the CPI and the PPI. But frankly, things are just a little bit oversold right now. And this bounce may have been a little bit attributed to some of that. The put call ratios on equities specifically have been greater than 1. This is the composite volume ratio on equities for 4 days in a row. You don't see that very often. The last time we had that was in late August, and the markets went into about a 3.5% rally. So when things get all negative everywhere, be ready for a bounce. And then the last thing we've got is Friday window dressing at the end of this quarter. We're quarter to date, we're down about 4%. A lot of fund managers are going to want to improve that performance if they can. All
right. Yeah, that's a good point, too, as we get to some interesting parts of the calendar. A little seasonality in the mix, too. Typically, September, not a great time. The 2 worst days of the year. Kevin Gordon, can we dismiss this as that? Because I sure see it on my Twitter feed. A lot of bulls going, hey, it's September. Don't worry about it.
I mean, you could always point to that. I'm not a really big follower of seasonality. I tend to focus on more, what's the breadth under the surface and what's the fundamental backdrop. And, as Randy was just talking about PCE and a lot of the data that we have coming up, I think PCE, for all the components that map over to that from PPI, you might not get as worrisome of a spike as we've seen in prior, months. But I do think key to keep in mind from an inflation perspective is that, some of the annualized rates, whether you're looking at 3 or 6 months or even over the prior year, especially for core PCE, the services part, and then excluding housing, is really not back to trend to where the Fed is completely comfortable. So if you pair that with what still looks to be a relatively tight labor market, and we'll get more clarity on that next week, I think the overarching picture there is that you're still not yet into the trend, settling into the trends, especially from a growth perspective that the Fed is comfortable with. So I'm looking at things from that angle in the context of what has been a pretty weak breadth profile over the past month. You've seen significant deterioration under the surface, not just in the S&P, but also the NASDAQ and the Russell. And as of yesterday, you were flat on the Russell 2000 year to date. You were just slightly negative for the equal weighted S&P 500. So yeah, I think you can get bounces from here once you get to this territory of being a little oversold. But if it's not accompanied by, if the bounces are not accompanied by, a majority of stocks participating in that upswing, I view that with a little bit of caution.
Really good point, because there's such a big gap between that equal weight and the broad market. And because of all that super big tech pull that we saw over the last year, the Russell's been so far left behind. I do kind of wonder, Randy, if maybe there's an argument to be made fundamentally, though, too, at this point, if small caps and more kind of cyclically oriented, economically sensitive sectors should be able to weather some of the higher rates this time around, if it's not because of runaway inflation, but just because of a better than expected economy and higher rates for longer.
Well, one thing's for sure is, like Kevin said, when you are unchanged year to date, but the market's up higher, and so that means basically that the big cap 8 are the ones that are driving everything. Just like we saw with previous rallies we had this calendar year, they're posed in a better position to take off when we do move to the upside. And frankly, I think if we get even some positive commentary out of DC about the reopening of the government. I know we're probably going to have a shutdown, but usually we get a little bit of a dip when that happens. But once they start talking about that they're working on a deal and they almost have one, then I think we'll probably see a rally. And all of that's going to coincide with the end of September, which is likely going to be the 4th consecutive September in a row that was negative. So you've got those seasonal patterns. I know, as Kevin said, it's not the most important factor, but it is a factor. You get the government either opened or at least discussion about it being open. You've got interest rates at this point essentially likely flat for the remainder of the year. The probability even of a December hike now is pretty small. You're pretty well poised for a pretty solid Q4 rally. I think that's definitely a minority position, But I'll just say let's wait and see.
Maybe my mind has just been broken by the bad as good trading regime of the last year, but when I hear Kashkari say stuff like a government shutdown could prevent the Fed from being aggressive, I'm thinking maybe the shutdown is what bulls want. Randy, am I twisted?
Well, again, shutdowns for the last 8 times have either been negative or positive overall. The one caution, of course, this time is that you've got Kevin McCarthy in a very precarious position. He had to make some really tough deals to get the role that he has, and his own people may go against him. But I think what we could see is actually the Democrats could bail him out because they can then use that as leverage for a future date. And no matter where you stand politically, the devil you know is almost always better than the devil you don't know. And if McCarthy gets replaced, I could see many of the leaders in the Democratic Party thinking that the replacement could be worse from their perspective. They wouldn't have any leverage. So that kind of deal making generally bodes well.
Yeah, it's an interesting angle. Putting that aside for a second, the data points, the next 2 days, what are we seeing in the market's potential for volatility around those, Kevin Gordon? I want to kind of close back to where we started here, full loop, because I would imagine with what's going on in bonds, we got to still be keyed into inflation coming on Friday.
Yeah, I think the mix of it, not just from the PCE inflation, the PCE deflator part of it, but also the mix of personal income, personal spending, what does the savings rate look like? And I would actually argue some of the data we've already gotten this week and then sort of at the end of last week, housing related, where you're starting to see a little bit of, a stunting of some of these rolling recoveries, whether it's in home builders sentiment, new home sales, existing and pending home sales, which we're about to get. I think that's actually more important because a lot of the cheering of some of the rolling recessions turning into rolling recoveries that we've been pointing out has been centered on housing. That was really the first economic domino to fall, go through its own recession, and then start to show signs of life. But if that's being stunted and rolling over again, you're not going to have a positive offset as labor and services start to show some cracks. So that's where you would get to more of a broad-based, wide-scale recession, kind of more traditional recession. And to your point about Kashkari earlier, a lot of his comments today too were about they might not need to do much more if it's because economic data are deteriorating. So if that's the case and it's being led by housing, I would pay much more attention to that.
Okay. Yeah, that has been kind of the rock. So if it starts to crack, then we've definitely got a little bit of a different situation on our hands than the surprisingly good stuff for the most part. And yeah, the housing data kind of soft earlier so far this week. Appreciate it, guys. Great stuff. Thanks for taking us into the bell. Randy Frederick, Kevin Gordon, excellent convo. We heard one of the bells there.